day, everyone. I'm Darryl McCoubrey, Head of Research at Veritas Investment Research.
Good day, everyone. I'm Nigel D'Souza, Senior Investment Analyst for Financial Services at Veritas.
And today we're going to be going through our outlook as we've been captured in our B list as currently positioned. Also look back to last year to see why we performed the way we did. Also some of our portfolio selections. Just a kind of brief summary of what the V list is. Created about 20 years ago. It's 12 to 25 names, so pretty concentrated. Equally weighted, we look to a gross return index to comp ourselves against. That's the S&P 500. And we tend to prefer larger names. Liquidity is better, all else equal. With regard to a process, how do we pick stocks? We start by relying on our analysts, and that's really the core, I think, of what we do. We listen to their ideas, including how they've adjusted numbers for accounting, and then we compare their core returns, which have been adjusted, to other assets that we think are similar. Once we get that perspective, we're at the third stage, which is where we're going to pick the ones we like. We're going to remove the ones we don't, based on this risk-adjusted return work that we've done. This is the team. As I said, I got Nigel here, and it's a big group, and we've got wide coverage across the TSX. So we feel increasingly confident, I think, that we get a really good information set when we're making our decisions. And with regard to performance last year, we did underperform by about just under 300 basis points or so. And we're going to get into some of the details of why we think that might have happened. Also, how we've positioned what we see today, and then why we are where we are today with the names that we currently include in the list. But just to give a longer term perspective, a lot of our models go out pretty long. A lot of our thesis can include things that aren't going to happen anytime soon. So over a longer period of time, it tends to show that our calls work out, both on the buy and the sell calls that we make to our clients. But having said that, we would like to see the short-term results obviously do better when it comes to the V list. And so we're going to get into a bit of the issues that we've noticed, how we're positioned, and also specific to my sector, why we chose some of the names we did. And this is just last summary slide. Won't have to spend a lot of time on it. Just showing the buys did underperform by a bit, while the sells actually underperformed as well, which is a good thing.
Thank you, Darryl. So this slide shows you our sector allocations for the V list. And as you can see, our weighting to more defensive sectors like staples, utilities, which Darryl will speak to more later on, and gold increased in 2023. And that is largely due to our approach of how we construct the V list, where we look at risk premiums across sectors and the risk versus return profiles of individual names, and then add the ones that we view as most attractive onto the V list. And in 2023, we generally felt that risk premiums weren't sufficient enough in more sensitive names and more cyclically oriented names. And that led to that overweighting in defensive sectors, which ultimately caused underperformance as more cyclically sensitive and risk-sensitive names outperformed in 2023. Now, speaking to my sector, financials, we do have a lower weighting to that sector. That's due partly to banks not offering an attractive risk versus return profile at the moment, and insufficient risk premiums being priced into that sector that aren't discounting the possibility of a recession or even a more moderate hard landing, let's call it. We have some insurance companies on the V list under financials, and that's due to our preference for insurance companies with less cyclical sensitivity and more attractive risk return profiles given their current valuations. Now, all that said, structurally, we do tend to be underweight both energy and financials in the V list, and that's due to the V list being a equally weighted portfolio of 12 to 25 names. So given that portfolio construction, it's very difficult or challenging to have a weighting to energy and financials that would be equal to the TSX weightings to those sectors. So while we are underweight financials at the moment, we would tend to, over the long term, be underweight financials and energy due to the way the V list is structured. Now, speaking of sectors, we did overweight utilities, and that had to do with the risk versus returns and the risk premiums we saw across sectors. And Darryl will speak to what he sees specifically in the utility space next.
Yeah, thanks, Nigel. Titled this "Flight to Safety Delayed," and this is specific to Canada. As you can, the first slide here is going to show what's happening in the US with utility performance compared to a broader basket of stocks, the S&P 500. And so that red line shows, this is the relative performance between the two, that the Dow Jones Utility Index has done relatively poorly since COVID, as we see risk premiums, which are the blue line, these are corporate debt risk premiums, have also come down. And so no need for a flight to safety if both the bond and equity markets both think things are fine. However, when we look to Canada, we see something a little more unique, and we've highlighted it here at the far right side of the chart. In Canada, again, generally the pattern follows that we saw with the US. When the blue line spikes, which is that corporate debt risk premium, you tend to see the relative performance of lower risk stocks like equity do better than a basket of generally higher risk stocks. But that hasn't played out, actually, not in the last little bit, as you can see at the far end of the line. The blue line, which is the Canadian debt risk premium, has spiked significantly, but there's been no corresponding outperformance by the lowest risk equities. I'd like to say this must be pricing in a soft landing, let's say, for Canada in the equities market, whereas it looks like the bond market's a little more concerned about things like sticky CPI and potential underperformance on real GDP. Of course, it's more than just valuation. So when we dig in by issuer, the one that stands out for us on the regulated utility side is Hydro One. They've got the highest implied cost of equity at today's share price by our discounted cash flow analysis. Their dividend growth is right up there with the best of them, higher than any of the regulated utilities. And in addition to that, their balance sheet is best in class. So we kind of tick a lot of boxes that we want in a name like this to serve as a form of a safe haven. For a little higher returns and a little more risk, the name that we like amidst the pipelines is Enbridge. We think Enbridge essentially matches the balance sheet of some of the smaller pipelines that people tend to prefer for that very one reason. They have lower debt to EBITDA. This chart, those red bars are showing FFO to debt ratios. I prefer it because it's cash based. And as you can see, although a little bit behind, Enbridge has essentially caught up with those two smaller pipelines that also have pretty significant environmental risk. They have more significant contractual risk. And then relative to TC Energy, the big advantage is that Enbridge's balance sheet is probably almost double in terms of their debt service metrics. And so that's the leg up that we were looking for: higher returns, better balance sheet. And it's why Enbridge is still on the list and TC Energy not yet. And that pretty much ends the prepared remarks. Nigel and I, or maybe you're going to see some of the analysts, we intend to do this a little more regularly this year, hopefully on a quarterly basis. But for my part, thank you for everyone who joined, and look forward to chatting soon.
Thanks for joining us.